Now, is Apple a really good buy? So this is one of the top five biggest tech stocks in US, where they always call it the FAM, F or FAMAC or MEGAF, right? It's one of the the biggest tech stocks, and everyone is talking about it. Now, is it a good buy? So in this video, we are going to do a very short analysis on how the fundamentals are doing, and also where are we at on the technical analysis. Now, during the early of the year, there's a pandemic crash, and after the crash, it has done a very strong rally after that. So now let's go into the details and take a look on that. So here, there's a short disclaimer. All right, pause the video, all right, and read. So now, if we look at the fundamentals, or sorry, if we look at the technical analysis on Apple, it has actually done a very strong rally over the past months. And what we can see here, there was a 35% crash during the pandemic between February and March. So what has happened is that actually it has actually tested this resistance that has turned into support. And here there's a strong reversal. So that reversal itself, actually, there's a huge jump in the price after that. So there's about 150% gain after that. So now the question is that, do I jump in now, or do I have to wait a little bit more? So now this question is very important, is because this questions drives you from one question to another, leading you into a more detailed analysis before you really own this stock. So now, normally as an investor or trader, we don't actually chase after prices, especially after a long rally and a parabolic surge like this one. It's like a 90-degree upwards. And now it is actually constrained in liquid, or we can call it in consolidation. Some people might see it as a symmetrical triangle. All right, so for me, currently it's a little bit more overstretched. I would like to see the price to be like, retrace a bit more further deep down and test one of the moving average and even the resistance right here before I consider to buy more. But will I really buy it? Now, it all depends on the fundamentals on the later part we analyze. All right, now let's move on. So now the first part that we look into a business is always that we want to know if the business is really growing consistently over the years. So here's a 10 years chart that I've actually extracted from Morningstar and employed into my graphs. And what we can see right here is that Apple, in the beginning of this year 2011 to 2015, it has gained almost double, almost 100% gain from there. All right. So in the year 2015, Apple has enjoyed one of the best years in this decade, because why? It has also one of the biggest cash flow at the time, and also like 53 billion in net income, the green color line, and 81 billion from the cash flow from operations. So then after several years, and Apple has been, the growth of Apple has been slowing down. So if we compare 2018 to 2020, so this is not a very huge growth from one year to another. And instead, this is just, there's a small decline right here. So more people, because there was quite an excitement during new launches of Apple smartphone in the early years of 2011 to 2015. But nowadays, because Apple phones can also last longer, right? And then what we can see right here is that 2018, more people are actually keeping their phones longer before they really buy a new one, because it's really a quality phone. All right. So that's also one of the factors, is also growing a bit, much slower at this moment. Now, how about in terms of percentage, if we compare the net income and the cash from operation? So let's move to another chart. So this is what I like to see. Now, how much of this company is making in terms of percentage on the profitability? So let's say, for instance, their net income is pretty much, I would say, stagnant. It doesn't really grow. So for me to really invest in a company, I would like to see the net income to grow. But in this case, is I would say it's double digit, and it is always more than 20%. And this is why a lot of people say that Apple is pretty much profitable, and because it's always in double-digit region. But what we can see right here, the cash flow from operation has been declining slightly from comparing from starting from year 2015. All right, but nevertheless, it's always more than 20%. All right, so this is okay, looks okay. Now, if we look deeper into the revenues growth, especially the green color bar, so of course, 2015, it has been a significant growth, 28%. Then after that, the coming years, then it has been really inconsistent with the growth. So now what I would say is that because in the top big tech stocks, you have Facebook, then have Amazon, which is the e-commerce giant. Then you have Google. So, and then all these companies, and Microsoft also as well, they do enjoy nice growth because of the network effect. And Apple is one of the companies that I do not regard it as a company that leverages on network effect, right? So, but of course, that I will talk in another topic or another video on the network effect. All right. So now, let's go a bit further into the business segment. So now, what is making Apple making revenues for Apple? Of course, what we can see here on the latest years in 2020, the revenue streams mostly come from iPhone, right? Second is the services. Now, I would say that iPhone is becoming more of a service, software service company. Because this services yellow color box, I mean a yellow color pie right here, refers to software services like iCloud, iTunes. So these services, they are actually from, if we compare from this portion against other parts, it's not a very big pie. In fact, this part is probably even less than 15%. But now, over the years, it has actually expanded more, all right? So other products and services are expanding more in the Apple's business. So now let's go into a further, more detailed breakdown, is that if we look at a more detailed breakdown on the devices that they're selling over the past years. So what we can see here is that the blue color part is the iPhone that they're selling. So you can see after year 2015, all right, this is this whole column is 2015, is that it's actually a bit, they have been struggling to actually have double digits growth. And even I mean, even if you look at iPhone, it's actually declining, all right? So if we compare the year of 2019 and 2020, it's declined about 3.2%. Now this is in fact not plus, it's minus, sorry for the mistake. And if we look at iPad, and if we look at the 9 years horizon right here, so now the peak was about 2013, right here. So it was about 32 billion US dollar, and it has dropped around 40% down to year 2018. So iPad is also suffering from losses, not really gaining from revenues that much, but it's just recently picked up about 2019, 2020, all right, which is about 11%, 11.4. Okay, and if we look at Mac, which is like a desktop, so this is more of a hardware machine, then it has been pretty consistent over the years, but the growth has been very gradual. Sometimes you see 1-digit growth, sometimes it's almost the same if you look at 2018 and 2009. But if you compare 2019 versus 2020, it's about 11.2% growth. So, which is still okay. We can say it's pretty mature for the market. Not much room for big growth. Now, what is really the big growth driver here? I mean, what are the really big growth drivers here? Other products such as a watch, iWatch. I think there's a smartwatch that links together with the iPhone. Then you have also these earphones that last longer in battery. Then also, of course, the other accessories like battery chargers and so on, which is really making a big growth in Apple's revenue stream. So, and even software services has been growing. All right, this is usually from their existing fan base, right? The loyal users, I would say. Right. So these are not just double digits. In fact, this is like 25%, which is the biggest growth is in the other products and accessories. Right. So now, okay. So now, if we look at the, are they, okay, does Apple really have a geographical advantage? So if Apple is all over the world as we know it, and if we look at the geographical areas that they have the most is actually in US. So it's about, over the years, it's about, 45% in US. And the second biggest market for Apple is in Europe, which is 25%. So all this data I've actually extracted from the annual report. So of course there are hundreds of over pages in annual reports. So we have to look at each of the pages and find these numbers and plot it inside these graphs right here. Right. So now coming back to here is that we know that China is about like the third largest market for Apple. Then coming on, you have Japan and rest of the Asia is roughly almost the same. All right, 7 and 8% respectively. Now, if we break it down on the regions, that what we can see, they have a very nice growth in US. In fact, if we compare 9 years ago up to now, it has actually grown about 400%. It's just that the recent years it has been slowing down, right, for the past 3 years. But if we compare this 38 billion versus 124 billion, yeah, 124 billion. So this is about 400% growth from this versus this one. All right, but recent years, comparing the latest year, it only has grown about 6.5%. Right, Europe is pretty much steady. All right, just a 1 year drop in 2019. Then it's about 13.9%. And in China, so in China, they've done a pretty good launch, which is they get about 58 billion, which is higher than Europe at the time, the revenues. And after that, it has been gradually declining. So this decline right here is almost about 30 to 40, between 30 and 40%, from 58 billion to 40 billion. So even on the latest years that we compare 2019 and 2020, it's about negative 77% drop. So this is the highest drop of all the regions in the globally. I would say China has the biggest drop for Apple. Right. So Japan also, they have been growing quite nicely, about 400% if we compare 9 years back, starting from 5 billion in year 2011. So of course, again, over the past 3 years, it has not been growing that much, and there's a small decline right here, about 0.4% decline. So if we look at the rest of Asia also, it has been actually increasing quite gradually, pretty okay. It's a bit about 10%. Right, so all these numbers doesn't add up to, doesn't give us a single decision that we should buy into Apple right now. So this is just one part on the revenues. So now the next thing is that I would always want to look at the future growth projection. And the most important number is that the forecast for this growth, the future growth for this company on the annual earnings, sorry, this is too thick, and also the revenues has to be at least 10% or higher for this large growth company, all right? So this is not considered a very positive projection, I would say. And if you even break it down, the revenues they are making within 5 years are not even 3 digits, right? It's only 44%. And if you look at the cash flow, which is in blue color, within 5 years, it's only increasing about 26%. So which is maybe 6, 7% or 5% per year they're projecting. So that's very slow. And if you compare this to greater companies is considered slow. So net income increased about 60%, which is, still not as good as other companies, better companies. Right. So again, if we look, compare this to the industry, what we can see here, the annual earnings growth is projected to be lower than the industry by 1%, right? And the annual revenues growth is also projected to be, this is almost the same as the industry. Now, for us to own a great business is that it has to beat the industry. All right, it has to be higher than the industry. And at the same time, it has to be double digits. So let's say if the industry is doing like 10%, I would like to see this to be around 15 or even 25% higher. Right, so now it has been really struggling right here. Not really a lot of positive growth projected. And this just for additional info. Earnings per share growth. So it's also around 60% within 5 years. It's just like net income for this. Now, if we look at the competitive competitive comparison or sustainable margins, I would say. So Apple has one of the highest margin in the industry, right? So I'll blank that away. So, and then of course they have the biggest market cap right here. And the size, if you look at the left-hand side of the chart right here, is that they have the biggest market cap. And it's like 4 times away from its second competitor. The margins are twice the time better than the second competitor, Samsung. So, of course, you see, when you look at this chart right here, you can see that the rest of the competitors are stuck within this area. So they are like clustered all together, you know, on the left-hand side. And there's a big gap right here. All right. So there's a huge separations. All right. So now, if you ask me whether they have a really big economic, wide economic moat, I wouldn't say so. Even in fact, Morningstar has actually graded it as a narrow moat company business. Because if we look at this chart right here, which is from the source credit is from Statista, this is one of the latest report we have seen is that in Q2 2020, we can see that Samsung is not growing that much, although earlier they have actually gained quite a lot of success right here. And then if we look at Apple, is that it's always maintaining its sales quite stagnant, the gray color area. All right, then you have a lot of other smartphones joining into the competition. So if we look at the right-hand side here, the pie chart, Apple doesn't have world dominance. It's only about 12% globally, the sales. Samsung has 22% globally. And it's usually always, the competition is always between Samsung and Apple. And now it's no longer a 2-horse race. You have Huawei joining in. Even Huawei's and Xiaomi's percentages are even higher than Apple. All right, then of course you have a whole bunch of others coming in. So it's not really even a high switching cost business, because others are always rapidly advancing, and it's hard for us to tell. In the early years, yes, we can tell the user experience is good using Apple. I've been using Apple for 8 years, but over the past years, that it's very hard for us to tell the difference between Android and Apple iPhone features. So they're coming very close. So it's hard to say that Apple has a very wide moat right here. All right. So it's like anyone can do it, this business. And okay, if we talk about dominance, the only area they have dominance is in US. And 40% is considered a good dominance. It's actually the #1 smartphone brand in US, because Samsung is always on their ass, like behind them. There's like 24% of the total market share in US. Right. Then, okay. So now that's all for some of the modes that we talk about. Not really much, because it's a highly competitive industry. And I would say that if we look at the balance sheet, it doesn't say much on the top left-hand side here. It doesn't say much. What it can say is that it has a lot of debt. This company is, yes, they have a lot of assets. It's more than their liabilities. Even the long-term assets is more than liabilities, which is a good sign for one of the financial health. And if you factor that on the current ratio, you have more than 1. As long as this part is more than 1, then this part is considered good. But this single one metric itself doesn't tell us about the entire picture of the financial health. So, and then if we look at the debt to equity history, and what we can see is that the equity has been dropping, but the debt is maintaining constant. So this is for about 2 years right now. So it's not really a very good positive sign for me to, for me to invest in a company. I would really want a company to be very conservative in debts, and this debt to equity ratio preferably to be less than 0.5. What is acceptable, or it is below 1. All right. So nowadays we don't just use debts, we also use capital lease obligation, which this is actually they started this in 2019 and 2018 for public listed companies. So last time we used to get just last time we used to actually take current debts, and also long-term debts over equity to calculate the debt to equity ratio. So, but now what we can see is that we have to use the capital lease obligation as well. Sure, rents and all that, right? But I wouldn't go too detailed in that. So let's say now we take all these three values, then we put into this equation. It gives us about also again 1.72, which is far beyond 1. So it's not really good, right? I would say it's quite bad in this. Now the last thing that I will look at is that in the debt servicing ratio. So the debt servicing ratio is like, how they can actually repay back the debts, how much they can repay. Let's say for instance, the acceptable debt servicing ratio is about 30%. But as for Apple, so their interest, the servicing their loans is not very high compared to their cash flow, because they have very high cash flow here, 80 billion. So if you actually use if you actually factor this into the cash flow, then it's only 3.5%. So this is extremely well doing on the debt servicing ratio, right? So of course, this is not one single metric again to actually make a judgment on this company. So it has to be some other things as well. Now this is one of the sources from Simply Wall Street. And this is saying that, this is telling us that this company currently now, the current price is about 131, but the fair value now is about 81. So it's about 62% overvalued. All right, another source from Guru Focus. So this is the current price, yes, is 132, but the fair value is about 62. All right, so this is around 100% overvalued at the moment. So it's significantly overvalued. Okay, now let's go to the third source, which is Morningstar. So I usually compare about a few sources. I don't actually look at just one source and say, okay, this is undervalued. Sometimes you might get different results from different sources, because they might have a different estimation, and they might have a different calculation. So, okay, but all in all, they are still using one of the base formula on the discounted cash flow for this. So now, even in Morningstar, what we can see is that the fair value is only 85. So this is around between 35 and 40% overvalued at this moment. All right, so all the three sources says that it's overvalued. So now let's move on next. So we have actually talked about a lot about fundamentals in these stocks and whether we should own it or not. So here's this Excel table. It's like a scorecard, which normally if I actually own a stock, I would actually want to see what is the overview of the scorecard. So I don't either pass or fail. I grade it with within 1 to 5, either very bad, fair, good, or very good grades. So there's 100 marks to be summed up. This is like an exam paper, whether this guy pass or fail, right, in this exam. So now, as for me, Apple, is that yes, the price trend is making very strong moves. So I grade it as 5. We know that the long-term uptrend is always going upwards, and it has been a many stock splits. I think it's even more than 7 times stock split for this one. But the revenues is not very good. It has slowed down to 6% comparing to 2019 and 2020. So net income stays the same for 8 years, doesn't really grow that much. All right. Cash flow, I would say it's declining slowly, not consistently growing, I would say. Then the future projections are not very good. In fact, the annual earnings growth per year is only projected to be around 8.5. It's lower than two double digits. See, all this, I'm looking at double digits for me to invest into a company. So where are they? Okay, do they have sustainable margins? Yes. In fact, they have the highest margin in the industry. The second highest would be Samsung, about 10, 11%. All right. Okay. Is this considered a brand consumer monopoly? Not really in globally, but they have dominance about 40% market share in United States only. Then, is it selling to worldwide? Yes, it's selling to everywhere in the world. Right? Except China, it has been declining quite rapidly. Then does it have a network effect? No, I wouldn't even grade this as 1. I just put it as 0. Doesn't really have network effect. So does it have a high switching cost effect? Not really. Because you have many competitors that are advancing, that are rapidly innovating. They have double screens, all those like really different features that would attract more users. So it's really uncertain. So I just grade it as a 3 at the moment. Although they might still have a better quality than others, but it's not really a big gap on that part. So overall balance sheet, not really much. I put 3. Current ratio is good. It's about 1.3. All right, as long as more than 1 is okay. It's considered very good. Debt to equity ratio, the current one, the latest one is 1.72. Then the fiscal, this one is combining with a capital lease obligation. It's about 1.72. Very bad. Right, debt servicing ratio is extremely good. It's only at 3.5. This is because their cash flow is strong, so they're able to service their debts quite well. Now, on the valuation, this is all grossly overvalued. You can see that most of them are overvalued by the 3 sources. 62% overvalued, 110% overvalued, 55% overvalued. It's a big no-no for me to jump in. But who knows, right? Even if the price can go, overvalued stocks can even go higher because markets can sometimes be riding on euphorias, and especially now we are in the year end, and who knows, the stocks can become even higher. But the thing is that I have better stocks to invest in because this overall percentage is just only 54% at this moment. So for me to invest in stocks, I would like to see this to be at least above 80%. All right, in this grading, then I would consider to invest in this company. Right. So if not, then I'll just wait for it to retrace, maybe take a trade on this, a very short-term trade. All right, depends on the technical setup. So okay, with that, I'd like to end the video and thank you for your time. Happy trading and investing.